The financial world is witnessing a quiet yet significant shift as central banks across the globe discreetly increase their gold reserves as part of their financial defense strategy. At the same time, Bitcoin, once deemed too risky, is gradually making its way into the long-term considerations of certain financial institutions and nations. These signs raise a major question. Are gold and Bitcoin truly starting to challenge the long-standing dominance of the US dollar in the international financial system? This shift is not merely economic, it also reflects changes in trust and the global power structure. Invisible shield: why central banks need reserve assets. After World War II, gold was once the cornerstone of central bank reserves worldwide, accounting for about 70% of total global reserve assets. However, over time, this share declined sharply, paving the way for the rise of the US dollar. By 2010, gold made up less than 10% of reserve portfolios, with the dollar taking its place and becoming the new symbol of global financial power. Yet, this balance of power is showing signs of shifting. Recently, central banks have returned to actively purchasing gold, and the idea of adding Bitcoin to reserve asset portfolios has also emerged. If this trend continues, both gold and Bitcoin could experience significant price increases, while the influence of the US dollar might be severely weakened. Is this wave of gold purchases merely a short-term reaction to market volatility, or does it signal a broader strategic reallocation? To understand this, we must first examine the role of reserve assets. Central banks use these assets as a tool to stabilize their national currencies, particularly during periods of uncertainty, serving as a buffer to help mitigate worsening financial conditions. A prime example is Japan. When the yen plummeted last year, the Bank of Japan had to sell billions of US dollars to buy back yen, creating demand for the currency and halting its downward slide. This is not just a technical move, it carries significant economic implications. A rapid depreciation of a national currency can trigger inflation, especially when essential goods rely on imports. A clear illustration of this is the tequila crisis in Mexico in 1994. Many companies and banks in the country had borrowed money in US dollars while earning revenue in pesos. When the peso sharply declined, they could no longer afford to repay their debts, causing the financial crisis to spread. For this reason, holding reserve assets is increasingly seen as a necessity. Reserve assets are not just a tool for crisis response, they also play a crucial role in maintaining long-term stability within monetary systems. Additionally, some countries use their reserves to actively manage exchange rates according to their strategic goals. For example, Hong Kong employs a currency peg system linking its currency to the US dollar. By buying or selling reserve assets, Hong Kong keeps its exchange rate stable, facilitating trade and shielding its economy from international market shocks. Understanding these dynamics explains why the US dollar remains dominant in reserve asset portfolios. Its strength comes not only from global acceptance, but also from the backing of a deep, stable financial market. When assessing the potential of other assets, such as gold, Bitcoin, or fiat currencies like the Chinese yuan or euro, investors and policymakers consider not just value but also trust, liquidity, and risk protection. The race to secure a top position in global reserves is not merely about which asset holds the highest value, it is a strategic decision where central banks must weigh economic efficiency, safety, and political factors. Recent developments indicate that the world may be entering a new phase of transformation in the global financial order. To fully grasp this shift, one must explore the key criteria policymakers prioritize when selecting reserve assets. Many people assume macroeconomics is solely a concern for governments, central banks, or policymakers. However, in reality, it directly affects individuals through inflation, exchange rates, interest rates, and economic cycles, impacting personal finances and investment decisions. Golden criteria for selecting reserve assets. When central banks worldwide consider reserve assets, they focus on three key factors: safety, liquidity, and profitability. This was the result of a survey conducted by the World Bank involving 191 central banks. Based on these criteria, it becomes clear why gold is receiving increasing attention and why Bitcoin is beginning to appear in discussions, though still only as a potential asset. Regarding profitability, fiat currencies have a distinct advantage. For example, a central bank holding US government bonds has earned an average interest rate of 4.4% in recent years. In comparison, euro-denominated bonds have yielded about 2.4%, while Chinese bonds have returned 1.7%. Gold, on the other hand, does not generate periodic income and incurs storage costs, effectively making its return negative at around -0.5%. Bitcoin, being purely a digital asset, does not generate any income at all. In the short term, these factors make gold and Bitcoin less attractive than holding government bonds. However, there is still one aspect that keeps gold and Bitcoin in the spotlight. Their value often rises significantly compared to fiat currencies, meaning that over the long term, gold or Bitcoin can appreciate substantially, generating profits without relying on interest rates. For example, the Czech Republic has expressed interest in adding Bitcoin to its national reserve portfolio. However, the unpredictable volatility of these assets makes them less favourable in terms of stable returns, especially when financial institutions prioritise consistency and risk management. In its role of protecting the national currency during financial crises, reserve assets must be easily convertible into cash at critical moments without causing market turbulence. This makes them essential for central banks. In this regard, Bitcoin faces a major hurdle. The daily trading volume in the Bitcoin market is relatively small compared to the scale of potential sales a central bank might need to execute during a crisis. This limited liquidity poses challenges when using Bitcoin as a reliable financial safeguard. Even a moderate-scale sell-off could trigger a sharp drop in Bitcoin's price, making policymakers hesitant to include it in national reserve portfolios. Gold and the Chinese yuan offer better liquidity, while the euro is even more resilient. However, the US dollar remains unmatched at the top. This dominance stems from its widespread trading across global financial markets, especially in the United States. As a result, if a central bank needs to sell dollar-denominated assets, it can do so without significantly impacting their intrinsic value. Liquidity isn't just about selling assets easily, it also involves efficient purchasing. In this regard, both gold and Bitcoin face challenges. Their limited supply makes large-scale accumulation increasingly costly over time. For example, if a low-income country attempts to expand its reserves, acquiring significant amounts of gold or Bitcoin could become prohibitively expensive, further complicating its financial strategy. If a country accumulates gold or Bitcoin as part of its reserves, it may unintentionally drive up prices, making future acquisitions increasingly difficult. Meanwhile, the United States consistently maintains policies that encourage trade, particularly by importing goods from many developing nations. This allows these countries to earn US dollars through exports, rather than having to purchase them directly. Over time, this practice reinforces the US dollar's position as the most widely held and accessible reserve asset globally. Its flexibility, combined with the depth of the US financial markets, makes the dollar almost unrivaled in terms of liquidity. The euro also has a strong presence, ranking second, but still falls short of the dollar's dominance. Large-scale gold transactions are complex, while Bitcoin trading lacks stability, especially when considering the scale required by central banks. Profitability and liquidity offer a glimpse into the appeal of a reserve asset, but the core assumption behind any choice is safety and reliability, especially during market crises. The volatility and inherent risks of Bitcoin and gold raise questions about their true capability in preserving national value. So far, the US dollar has retained this role relatively firmly despite political and economic challenges. The next question to explore is whether gold and Bitcoin can truly become safe haven assets, or if they remain temporary speculative instruments, a discussion that will be examined in the next chapter. Safety first, the silent battle for stability and trust. In the world of international finance, the concept of safety in reserve assets typically revolves around two key factors. The first is price stability, meaning the asset experiences low volatility over time. In this regard, gold and Bitcoin are often considered less reliable. Both have a fixed supply, while demand can fluctuate unpredictably. This dynamic makes their prices prone to sharp increases or declines, limiting their role as truly stable reserve assets. History has shown that gold has experienced considerable volatility, and Bitcoin even more so. In 2022 alone, Bitcoin lost over 50% of its value, though it rebounded strongly in 2023, allowing central banks to recover some of their losses. However, central banks do not operate as investors seeking profit. They serve as defensive forces during financial crises. They require stable assets to protect their currency in turbulent times. An asset like Bitcoin, which can lose half its value in a matter of months, presents a significant challenge for them, making it hard to justify as a reliable reserve. Some argue that if Bitcoin were more widely adopted, it would become more stable. However, even gold, which was once the global monetary standard, has remained volatile, even during its peak periods. Bitcoin is likely even more prone to fluctuations as its supply is more constrained than gold's. Therefore, in terms of value stability, fiat currencies, particularly the US dollar, are still considered a safer choice compared to gold or Bitcoin. The inefficiencies in the gold market, its low yield and frequent volatility have been key reasons why the US dollar has maintained its dominant role in national reserves. Additionally, the strength of the US economy has driven the global liquidity of the dollar. However, things are changing. Signs of a significant shift are emerging as central banks ramp up gold purchases at increasing volumes. The key question is, what is driving this trend? Are nations rethinking the value and safety of gold? This shift isn't just about economic factors. Geopolitical disruptions, complex international relations, and hidden risks are prompting countries to reassess their reserve strategies. If the global order changes, long-standing assumptions, such as the absolute dominance of the US dollar, could start to waver. At that point, alternatives like gold and even Bitcoin may be seriously considered as safe haven assets for the future. To gain deeper insight into the strategic reserve shifts of central banks, the next section will explore the real motivations behind this wave of gold purchases, the return of gold purchases, and Bitcoin's uncertain future in reserves. In recent years, as political tensions have escalated and financial sanctions have been imposed by the US, the UK, the European Union, and Japan, central banks have responded accordingly. A research team from the International Monetary Fund, IMF, has identified a clear pattern. Whenever sanctions are introduced, many central banks begin buying gold again for reserves. This trend is particularly evident when reserve currency issuing nations are the ones imposing sanctions. Holding assets in US dollars or euros is becoming less secure, prompting a renewed interest in gold, which has long been regarded as a safe haven asset. However, storing gold is not straightforward. It is difficult to trade, especially if the owning country is under sanctions and cannot access major vaults in London or New York. In this context, Bitcoin emerges as a potential alternative. As a digital asset, Bitcoin can be transferred across borders without relying on traditional financial hubs. While the process is somewhat complex, it is still simpler and cheaper than physically transporting gold. However, there remains a significant gap between theory and practice. Recent World Bank studies indicate that Bitcoin has yet to gain acceptance among central banks. The primary reason is its extreme price volatility and lack of sufficient liquidity. As a result, a more practical approach for countries like Russia has been to restructure their reserve portfolios, reducing reliance on the US dollar and euro while shifting toward currencies like the Chinese, yuan, or Indian rupee, which come from politically friendlier nations. The future remains uncertain, with no guarantees. Will central banks continue accumulating gold, and will they eventually hold Bitcoin as part of their reserves? If that happens, key questions arise. Could gold and Bitcoin see significant price surges? And could the global monetary order shift as a result? For decades, the US dollar has been the centerpiece of the global financial system. Now it faces challenges from both gold and digital currencies. While gold is reaffirming its role, Bitcoin represents a pivotal shift in the digital age. The future of reserve currencies is still taking shape in a world that is constantly evolving. The reserve currency of the future global reserve currencies tend to change very slowly, mainly due to the network effect. The more widely a currency is used, the more valuable and stable it becomes. As a result, a major shift away from the US dollar is unlikely in the near future. There have been reports that economic advisors during Donald Trump's presidency suggested that countries wanting to continue using the US dollar as a reserve currency might face conditions, such as contributing to US defense spending. Overall, the dollar remains the top choice for central banks due to its core advantages: high liquidity, widespread acceptance, and strong financial security. History has witnessed a shift from the British pound to the US dollar, yet the transition took more than 6 decades, despite the US surpassing Britain as the world's largest economy much earlier. This demonstrates that even if the dollar's role declines, the shift will not happen quickly. Additionally, fiat currencies like the US dollar and euro are seen as far more stable, given the ability to control their supply. Even in the event of a major global crisis, the likelihood of central banks fully turning to gold or Bitcoin remains very low. In an era where the global order is becoming increasingly fragmented, many central banks have intensified their gold reserves as a hedge against political and economic risks, whether from the US, the European Union, or China. In this landscape, Bitcoin, if widely adopted and more liquid, could play a role. It has the potential to become a digital asset similar to gold, due to its cross-border mobility and large-scale trading capability. If central banks increase their investment in Bitcoin and gold, the prices of both assets could rise further. However, much of this expected impact may have already been priced into the current market, and no one can predict the future with certainty. Ultimately, while gold and Bitcoin may struggle to replace the US dollar in the short term, their resurgence, especially Bitcoin's, suggests that the financial world is entering a new era of volatility. Thank you for joining us in this video. Goodbye and see you in the next videos.